One dog didn't bark in 2013. The eurozone got through the year without a fresh debt crisis for the first time since 2009. Debt markets recovered and money came back into stocks, even if the eurozone economy remained weak or, in case of Spain or Greece, truly nightmarish. I and others had predicted that Europe's leaders would need another crisis to force them into the reforms they needed. It hasn't happened. What's the chance that could happen in 2014?
I think it's very low given how far we've moved in terms of the institutional framework, but also the economies in these countries. We've seen a stabilization of growth and surprisingly the data is showing that for the past 3 quarters Portugal and Greece have actually bottomed out and have had positive growth. So I think from here it's going to continue, but it's going to be a very modest recovery.
So if we were to see a fresh eurozone crisis now, it would probably be because growth has disappointed.
We'd need to see some sort of catalyst to create a new eurozone crisis, and that catalyst would probably be a lack of growth.
If Europe does fail to grow, then suddenly a lot of weight falls on the European Central Bank, which has said it will do whatever it takes to save the euro.
That is not our base case. It's not out of the realm of possibility, though, and it's a good reminder that Europe presents a significant risk to the global recovery story. The reason that vulnerable countries like Italy and Spain don't present a near-term threat is because of the ECB and their OMT program. If we come up against Italy's election and we have a dysfunctional political outcome, which is not impossible given Italy and their history, then you may see a spike in their bond yields, at which point, in theory, you test the OMT program. Remember, we haven't actually had these countries enter the OMT program yet. It's just been the threat of what the OMT program could do, which has kept the bond yields from spiking. That's a big question mark for 2014.
And there's another issue, which is that US interest rates are likely to rise as the Fed tapers off QE. That could cause problems for emerging markets, but also for the periphery of Europe.
The region we're more concerned about is Europe, and in particular its periphery. There are a number of over-indebted countries which are not well placed to see what we expect to be a global rise in interest rates, in long-term interest rates. The model we're using in our heads and we tell our clients to observe is 1994. When the Fed raised interest rates, the US economy sailed on serenely, went on to enjoy its longest period of unbroken growth in its recent history. South of the border, Mexico fell over. A couple of years later, Asia fell over. A year after that, Russia fell over, and so on. Because when the denominator moves, the balance of risk and return and reward for investors changes, and money comes home to America when American interest rates rise.
The euro has definitely been defying expectations, strengthening while everybody was expecting it to weaken. Interest rate differentials with the US are going to be key going forward, and the euro's fate is more in the hands of the Fed rather than the ECB's.
Europe has made real progress. The risks of a further crisis or of a euro breakup are definitely less than they were, but they haven't disappeared. If growth doesn't materialise, the pressure on politicians will be intense, and this has always been primarily a political crisis. Don't bet the house on the eurozone just yet.